Jimmy Lee, the S&P is up over 6% year to date. A lot of people say that the rally is going to be ending soon, but you say it can go further, maybe even 3% higher. Why such optimism?
So that's not too much higher, Greg, but that's been our prediction from the beginning of the year. Our model suggested maybe a top at about 22.40. But when we get to those levels, if we don't have earnings to support that, we're very fearful of a fairly good correction. We haven't had a bear market since 2009, so I really wouldn't be surprised if we had some sort of a shock at that point at those levels that could cause a pretty good correction at that time.
So meanwhile, even though you're bullish, you are positive on consumer staple stocks. They've been one of the leaders in the first half. It's a pretty defensive area for a guy so bullish.
So we think we're sort of in the mid to late stages of the business expansion that we've been in for a very long time, and we're a little long in the tooth. Investors all over the world are looking for yield, Greg, and consumer staples is a good sector to invest in during the late stages of an economic cycle, as well as when you're looking for dividends.
And you like multifamily housing as a demographics play. So how are you playing this? Through REITs? Because REITs, like consumer staples, did very well in the first half because it's a yield play.
We are playing it through REITs. In fact, they're non-traded REITs, and we like that because we think that with interest rates rising, it could have a potentially negative effect on the publicly traded REIT sector. But the REITs are how we do it, and we do like the multifamily housing. We think that demographics suggest that baby boomers are going to be downsizing, and also the millennials, they've got a lot of student debt, and it's hard to get the down payment that you need to be able to buy a home.
Meanwhile, you are cautious on international stocks. Now, is this Europe as well as the emerging markets? Because the emerging markets have actually outperformed the S&P in 2016.
Yeah, you're leading me right into my answers here, Greg. The developed countries, the EU, that's where we're worried. Brexit, we don't think a lot of other countries will follow, but the concern about it and the risk out there that potentially could happen, we think causes some problems out there. But for a long-term investor, emerging markets are definitely an asset class they need to own. And right now, well, we took a position in emerging markets earlier this year, and right now we think it's a good time to invest for the long term.
So I see what you're doing on the equity side and where you're trying to find yield, but what about on the bond side? How are you counseling your investors, your clients, when you're seeing yields at record low levels still on the fixed income side?
High quality, Greg. I think investors need to be wary of searching for yield and chasing yield. And high yielding bonds act a lot like equities, very highly correlated. So if we get a downturn in the equity markets, those types of bonds won't hold up as well as a high quality. So we're going high quality corporate and in the municipal sectors too.
All right, well, thanks a lot, Jimmy.
Thank you, Greg.
And thank you for watching The Street.